Hi, I am Anna. I come from www.ntvforex.com. China, Treasuries, and the Fed Analysis. http ntvforex.com News ID 39661B9/11/2020 4:34:48 p.m. China recently announced it would slowly be selling off a portion of its U.S. Treasury security holdings. Some analysts have called this the A nuclear option A, while many major news networks have been avoiding the development altogether. China currently owns over $1 trillion in U.S. debt securities. Their holdings are to be slashed by around 20% to $800 billion if recent reporting on the matter is accurate. How does this impact the U.S. bond market and dollar? Can it hurt the fiscal position of the United States? First, it is important to note how the U.S. Federal Reserve already owns well over $4 trillion of Treasury securities. Looking at the chart below, we can compare the growth in ownership of U.S. Treasury securities between the U.S. Fed Blue and the international community Red. The chart is indexed to 100, beginning from the date recognized by the Fed to be the start of the 2008 recession. The chart above shows that the U.S. Federal Reserve has now dislocated itself from the rest of the world and has become the largest buyer of U.S. Treasury securities. This can be taken as a message to foreign investors that thanks to U.S. monetary intervention, the compensation for investing in treasuries will be artificially held down at any cost. Second, we can compare the two main ways foreign treasury selling can impact both the bond markets and the Fed. This will help to imagine what China's selling could do to impact markets. Scenario 1: naturally occurring, a foreign entity sells treasuries in the open market, a transaction between two willing entities, neither being the U.S. Federal Reserve. This scenario naturally places downward pressure on the price of Treasury securities, while placing upward pressure on their yields. Inverse price-to-yield correlation. Before the days of central bank quantitative easing and AMMTA, this would be the only way for foreigners to sell treasuries. Scenario 2 preferred by the Fed. In Scenario 2, the Fed steps in and buys the security from the foreign entity was selling. The Fed gains an asset on their balance sheet, treasury bill, and creates a liability in return, newly created deposits, which can be referred to as a funny money, fresh off the printing press. The key here is that the Fed's intervention in the transaction stops treasuries from being sold in the open market. Scenario 2 is preferred by U.S. central planners because their goal is to avoid upward pressures on yields at all costs. Higher yields on U.S. Treasuries mean a higher cost of borrowing for the U.S. government and higher refinancing costs when rolling over their existing debt. In plain terms, Scenario 2 means more Federal Reserve money printing, and more highly manipulated U.S. Treasury markets. However, this can only be used as a legitimate tool for so long before foreign creditors lose confidence in the U.S. as a debtor. Eventually, the Fed could end up with all the U.S. Treasuries currently held by foreigners on its balance sheet. The question that follows is, by this time, would the U.S. dollar lose its viability in the international community? To answer this question, recall Ray Dalio's statement from Davos in January of 2020: "A cash is trash. For now, what can investors expect? The Fed could easily absorb the selling of treasuries by China that is incoming. The Fed's balance sheet would expand by $200 billion and yields would not move meaningfully higher." Scenario 2 above. China gets paid, and the Federal Reserve increases its footprint in the fixed income markets. What investors should watch for is whether other nations will follow in China's footsteps. If others follow China's lead, more pressure would be placed on the U.S. central bank and the U.S. dollar. Furthermore, if an investor wanted to profit from China's move, they could front-run it by anticipating which assets the Chinese are likely to buy with the treasury proceeds. Hint: they don't like US dollar, they love a certain yellow metal. The Chinese are likely to replace their US treasury holdings with gold, which they have been buying in large quantities ever since the GFC in 2008. For your information, here are the largest foreign holders of US treasuries, as of June 2020. This data can be found on the U.S. Treasury's website. Investors will need to pay attention to the actions of nations like Japan, the UK, Ireland. As of right now, there is little reason to believe that other large foreign treasury owners will liquidate their holdings immediately after China. If they do, it will test the Fed's resolve and rates could rise if the US cannot keep things under control. The other option is the Fed prints a wild amount of US dollars to absorb the wave of foreign treasury selling. Two things investors can surely count on: the Federal Reserve's balance sheet is nowhere near expanding, and gold is likely to be the preferred reserve asset over US treasuries in the future. To finish, here are some interesting charts which show China's preference for gold as a reverse asset over US financial assets. 2. Who owns all of the United States debt? NBSP. Subscribe our channel to receive the news as soon as possible. Thank you for watching. If you want to read real-time news, text messages to MT5 Expert Advisors page at https://mt5.expert.advisors.